So our second keynote talk is by Arthur Gervais, is a rising star in the area of blockchain and fintech. Arthur is a lecturer, which is equivalent to assistant professor in North American system at Imperial College London, and he's been a very passionate person in pursuing information security. He has worked in blockchain-related topics since 2012 and has recently focused on decentralized finance, or DeFi. He has been the co-instructor in the first DeFi MOOC, which is massive open online courses that has attracted more than 3,000 students in the fall of 2021, and is going to be teaching the similar course in the fall of 2022. So that's if you're interested in DeFi MOOC, that's the opportunity. Some of his he has, as we said, he has worked on blockchain, and some of his highly cited work that are directly relevant to blockchain and how they really use in practice and should be used in practice. There are topics like, do you need a blockchain? So this is the title of a paper, or on the security and performance of proof of work in blockchain. So these are highly cited, thousands of citations, and really the question that is on top of everyone's mind. So today he's going to talk about how dark is the forest, and on blockchain extractable value in DeFi. And the floor is yours, Arthur. Thank you.
Ray, thank you so much for the kind introduction. We appreciate. So before diving into the dark forest, I would like to disclose a question behind a tweet I've done a few weeks ago. And that's because it's quite related actually to Ari's lecture on NFTs. So on the 13th of May, I asked here, what caused the spike and drop on the Ethereum peer-to-peer network in the number of transaction hashes that were broadcast? So to give you a little bit of a background, so we are running Ethereum nodes, and blockchain nodes in general. We do save what we see on the network layer into local databases so that we can use that data for empirical analysis and works. One particular thing that stood out here was that during my night, at least here in Europe, at some point there was this, at 3 a.m. in the morning, there was this spike in number of transaction hashes. And it turns out this was an NFT event. One of the Bored Apes, as you have very eloquently just heard from Ari. And I thought this is maybe an interesting example where you can see bots in action, or many people in action, supposedly bidding on the peer-to-peer layer. And then what's also interesting, we can see like a slight downturn in usage afterwards. So it's not directly related to the dark forest, but the dark forest is a forest full of bots that are acting and competing similar to this particular event here. So today's talk, I hope that the transition wasn't too cringy, but so today's talk will be mostly about the dark forest in terms of financial applications where people are competing. So you can see here we have these obscure entities that may be attacking your trade or trying to extract value out of your financial operations. I will not be discussing NFTs, although they could be perceived as financial instruments as well, and probably should be studied in a similar manner. So some of you may be familiar with the book of Michael Lewis on Flash Boys. Ari actually had an excellent paper on Flashbots 2.0 that was inspired by this very book. So Michael explained all the possible malicious actions that could be performed by a trader. And I would recommend you also going on Investopedia, for instance, to understand all the malpractices that are being that malicious traders have come up over the years. They have been really creative. It's like a it's an amazing source of creativity that you can find there. And naturally, the regulators, especially in the US, followed up to set rules of what is okay and what is considered malicious. For instance, spoofing is a particular type of malicious activity. And there have been fines by the SEC against high-frequency trading firms, for instance, to pay because of apparent malpractices. Now, nowadays, if you open a bank account, in particular, also in Europe, you have advanced regulations that try to understand your investment profile. So whether you understand what you're doing. So for instance, whether you understand what a bond is, what a security is, what a derivative is, etc. So the regulations have tried to protect the investors and have tried to come up with more and more so-called just regulations for everyday investors. However, these have so far been mostly absent in the DeFi space. And because they're absent in the DeFi space, you could technically go to all these malpractices in the traditional world and try to apply them to the DeFi space. And this happens to some degree, but there are quite a few sources of novel malpractices that are very application specific to DeFi. So I've mentioned DeFi quite a bit, but let's quickly look at the time frame of how this evolved. So as most of you know, Satoshi Nakamoto presented Bitcoin in 2008. It was published, or the blockchain started in 2009. Then a few years after, Ethereum came about and facilitated the design of smart contracts. And given this facilitation of smart contract deployment and interaction, we have seen the emergence of an alternative financial system, which is called decentralized finance. It's relatively tightly intertwined with the traditional financial system, in particular due to reserve-backed stablecoins, but it kind of tries to stand on its own in general. So on a high level, what is DeFi, right? So what are the different components that DeFi is composed of? So on the very bottom, on the network layer, you can see this is where the data among peers is exchanged. So this is where peers are exchanging transactions, miners are exchanging new blocks. So this is relevant for the blockchain consensus layer. So where the state of the blockchain changes. So whenever there's a block appended, there's a state change compared to the previous blockchain state. And due to the facilitation of smart contract applications, we have an application logic state. So this is where you could think of installing an application such as a smart contract on the blockchain, and where you can also call different functions of your smart contract. And so this distributed database gives ground to a variety of DeFi services that have been proposed in the past years. The most prevalent are exchanges or swaps. Some of you might have heard of Uniswap, which is an automated market maker. It's one of the most basic DeFi primitives out there that are being used to exchange assets. You can find lending and borrowing facilities. You can find over as well as under collateralized lending. You can find so-called flash loans. Flash loans is a new type of loan that doesn't exist in the traditional financial world, as far as I'm aware. It's a type of loan that has no temporal component. It's a loan that's valid within a single atomic transaction. So there's literally at the beginning of a transaction, you can take the loan, you can do something with the lent money, and then with the borrowed money, and then you can pay it back by the end of that transaction. So it's as if you program a loan within a single function call, and you cannot use it outside the function call. So there's no temporal component in the sense that the loan doesn't exist for like a number of days or so. I already mentioned stablecoins. So this is where DeFi is heavily intertwined with the traditional financial world. You might have heard about USDC from Circle, or USDT from the Tether company. These are US dollar-based stablecoins, and hopefully these stablecoins are fully collateralized on in a corporation that issues this stablecoin on chain. So as such, you have a legal entity that has a reserve of currency, and then it issues coins on a blockchain. So as such, there's a relatively strong economical link between the stablecoin on chain as well as the legal system. In this particular case, it's the US. We've seen a lot of derivatives. There have been a plethora of privacy mixers, etc. So what's interesting is that these DeFi services, they all support similar asset standards. So despite having such a decentralized system, we have all these protocols. They're following kind of community agreed asset standard rules. And these standards allows these protocols to be intertwined in a very composable way. So you could, for example, you can collateralize some coin on a lending and borrowing platform. You get a receipt and a staking token back. You could exchange this on an exchange. Then you can create another derivative of it, etc. Right? So you can literally chain these different coins in a way that's quite akin to like money Lego, right? So it's quite interesting to play with. And naturally, because we have these variety of services and asset standards, we can then, the market came up with market mechanisms that are just, I would probably say, standard in the economic sense. So I'm not a finance expert, but I suppose this is just how these economic markets evolve. So if there's a difference in price between two markets for the same asset, then there's an arbitrage opportunity that arises. If there's a debt position that becomes unhealthy in the sense that the collateral declines in value, then there must be a liquidation event. So this is also rather traditional. And in DeFi, we have a number of governance mechanisms, so you can vote with your token on the evolution of a DeFi protocol. So, all right, we understood DeFi so far, but what is blockchain extractable value? Where does this come about? So I've mentioned the lending protocols. So a lending protocol is typically something where you have a pot of money, and this is, for example, the collateral that was given by somebody who wants to borrow a certain amount of coins, right? So if this collateral that was provided as a security deposit, if this collateral drops in value, because we know how cryptocurrency prices are rather volatile, then it could happen that the smart contract will trigger a liquidation event, meaning the debt position that's associated to this collateral will become liquidatable. But now the question is, who will liquidate? Is it a miner, because the miners can order transactions in the block? Is it just a regular debt position holder? Or is it some high frequency trader that tries to take advantage of the so-called spread that the liquidation offers? So a liquidation typically comes at a cost of the borrower, because the collateral is sold at a discount to incentivize liquidation, to incentivize liquidators to close this unhealthy debt position. So the fundamental question is, who will liquidate, right? And we don't really know. In the traditional world, well, if you take a loan or a mortgage on your house, it's probably rather clear who will liquidate, right? You have your bank that may do the liquidation, or some third party that's designated to do so. One important component in understanding where this liquidation plays a role is transaction ordering, right? So if you have transaction 1, 2, and 3 here that come about in this very order, a miner could then order those transactions at any potential order, right? Let's say the miner will order it in here, this T2, T1, T3, although the miner received transaction 3 before 2 and before 1. So can anybody tell me, or has anybody an idea why the miner here in this particular example would prioritize transaction 2. Any idea why that would happen? Larger fees, high gas fees. Oh, three answers, very quick, nice. So absolutely, right? So transaction 3 is likely to pay a higher fee or reward to the miner. And therefore, the miner is willing to prioritize the execution of that very transaction. Right? And this is how the transaction ordering in at least permissionless blockchains is occurring nowadays. And this is also the primitive that allows high frequency traders to prioritize their own transactions. So the miners retain the privilege here to control single-handedly the transaction order. That's not a decentralized decision, right? It's a kind of like it's a single-handed decision at the miner's discretion. All right, so we roughly understood what is extractable value. What is then the extracted value? So how much was extracted so far? To understand this quantitatively, we have performed an empirical analysis of the Ethereum blockchain over a time frame of 32 months. And we have found a bit more than $500 million US in profit that was extracted. The dataset we have used is the public Ethereum blockchain. So we've looked at about 11,000 unique addresses, 50,000 cryptocurrency markets, and 60 cryptocurrencies and 60,000 on-chain markets. The reason why we've looked at so many cryptocurrencies, because obviously most of them appear minor and are not like very important coins, so to speak, is that we have observed that if we do not include smaller markets, we are missing quite a large number of extracted values. And this is likely due to the fact that the smaller a market is, the higher the price impact of a trade becomes. And that's where traders or blockchain extractable value traders can extract more profit. So we have not yet looked at other blockchains, right, such as Avalanche or Binance Smart Chain, but that's certainly something that should be looked at in the future. So I'm quite curious how this will look like on other chains, but let's currently focus on the Ethereum blockchain alone. The 3 sources of BEV that we have specifically looked at are sandwich attacks, liquidations, and arbitrage. You already know liquidations. You already know arbitrage from earlier today. Sandwich attacks are kind of the only malicious source, so to speak, that we've looked at, because liquidations, it's a design of a protocol. Arbitrage is there to improve the efficiency of markets, so it's typically considered benign. There will be a 4th source that I will explain to you later, but so far let's focus on these 3 sources. And in particular, let's look at sandwich attacks. And to understand sandwich attacks, let me first explain how a decentralized exchange works. So a decentralized exchange, or the idea of a decentralized exchange, is to let the smart contract do the market making. So market making is the process of serving the market. So whether somebody wants to sell or buy an asset, right, you want to serve that person such that the market remains liquid and active. One very popular formula to perform market making is this X times Y equals K formula, where X represents the asset quantity of an asset X, Y the asset quantity of an asset Y, and K a constant K, which should remain constant while you're trading with the automated market maker. So what I haven't said yet is that this automated market maker, you can think of it as a pool of money. It's a bag of money, and it will only trade with you if you respect this formula, right? So the nice properties we get is that you get instant liquidity irrespective of the trade size, but there's a price impact. If you purchase an asset X, well, this will increase the price of X, and vice versa, decrease the price of Y. The ratio of X and Y sets the price, and this is commonly known as the constant product AMM. Now, if we visualize how this AMM operates, you can see here On the x-axis, we have the amount x of an asset x in the pool, right? And on the y-axis, we have an amount y of the asset y in the pool. So this AMM is a big pool of money or coins, and there are two coins in this pool, right? X and y, given a certain ratio. And this ratio sets the price. And let's assume we're here at a given state where we have 10 assets of the asset X and 30 assets of the asset Y. So therefore, the constant K is 300. Right? Now, I've got a question for you. So if we want to receive 10 items or 10 coins of the asset Y, how many coins of the asset X do we have to provide to the pool? So we want to reduce 10 coins out of this pool. So we should go to 20, right? How many asset X do we need to provide to the pool such that the pool is willing to make that trade? Right? If we receive from the pool, we need to give back something first. Any idea? I see some answers in the chat. 15. Very good. It's not, we don't have to give 15, but it's 15 minus 10, which is 5, right? So but Ray, very correct. You wanted to go to the state 15 here, correct? So we have to give 5 to this pool, and then we'll get back 10 coins of the asset Y, right? So that's the typical way of how a DeFi exchange performs a trade. And that's it. Now you know everything about DeFi. We can go home. No, just kidding. But this is the most important primitive for DeFi, definitely. So everything is based on this concept of having a pool and such a bonding curve. So very good. So naturally, if a trader here trades with this pool, right, we have this transaction that pushes the price along this bonding curve. So for example, if a trader puts in 5 assets, the trader gets 10 assets back. And what can happen now is that the trader is so-called sandwiched between 2 adversarial transactions, right? So we have one transaction here and another transaction there after the victim. So the very first transaction here you can see is visually, it's pushing the price down, and therefore the victim starts at the later price instead of where the transaction A1 started to execute. And you might observe here the slippage protection mechanism. So the victim can specify by how much the victim wants to be pushed, right? So typically we have, in the blockchain setting, we don't know exactly at which state our transaction will execute. So therefore there's a certain flexibility in terms of price at which we want to execute. And this flexibility is called the slippage. And we can specify what's the maximum slippage that we're willing to go to. So that's then the slippage protection. And if the adversary knows your slippage protection parameters, which is public, the adversary can push you just to the edge, but not over the edge, and then try to background that transaction with a second sandwich transaction to profit from that trade. Right? So this is called a sandwich, most likely because the victim transaction is just a juicy piece in a bread. But yeah, that's not the name we came up with. So the community, the blockchain community came up with this name, but I find it quite pleasing here. Okay, so in this particular case, you can see here that the victim really received less assets than it should have without that attack. And yeah, we're seeing such attacks happening every day. So the very moment that we started this work, you can see here, this was actually in 2018, when we started measuring the sandwich attacks. There were roughly the profits that were taken out of sandwich attacks were rather low, right? Even less than $1,000 US. Here you can see we saw less than 100 sandwich attacks per month. Whereas nowadays, respectively, end of 2021, you can see here that we have seen almost, I mean, we've seen sandwich attacks in general almost reaching $100 million profit per month, which is a rather significant amount. So sandwich attacks have been really small a few like 2 years ago, but have grown significantly with the adoption of DeFi. On this chart, you can see we have looked at a variety of exchanges. We looked at Banco, Uniswap, and SushiSwap, right? So these are the most prevalent exchanges on Ethereum. So regarding liquidations that we discussed at the very beginning, we can see here that liquidations are a bit more volatile. That's mostly because liquidations happen in particular in market downturns. So if the cryptocurrency prices decline, naturally the collateral that is backing loans is also declining, and hence we're seeing more liquidations. In total, we have measured over 90 million US dollar of profit from liquidation events alone. Last but not least, arbitrage. So we can see here we have we're capturing a few more exchanges, notably Curve. That's a stable coin exchange. And arbitrage has been quite significant as well, reaching almost 100 million in profit on decentralized exchanges alone. Note that we are not capturing, in this study here, we're not capturing any type of exchange that's going beyond the blockchain, right? So that's going to a centralized exchange or across chains. So this is really just a focal view on a single isolated blockchain database. All right, so these were the three main sources of BEV or blockchain extractable value that we have discussed so far. There's a fourth source, as I promised, and that we will look into now, and that's called a transaction replay attack. So transactional replay attacks are a new type of attacks that we are observing on the existing DeFi-enabled blockchains. In particular, these are really copycat or replay attacks. So replay in the traditional network security setting is where, well, you're literally trying to replay a packet, right? And that's not much different here. So you observe a transaction on the network layer or wherever you find transactions from. You replace certain data, you sign the transaction, right, such that it becomes a valid transaction, and you broadcast the copy. So now what's key is what data you replace in the transaction, which I will discuss in the next slide. But let me quickly allow you to explain why this transaction replay is interesting and important. It's because over the same 32 months time frame that we have analyzed the replay, or a potential replay attack, we found that this replay can generate over 35 million US dollar in profit. So note that this is not extracted, so it's not something that was extracted, but we simulated based on past blockchain data that this could have been extracted. Right? So we found about 0.02% of the transactions being vulnerable to such a copycat attack. And I will just show you now a real-time algorithm that's really simple, 3 lines of code. And it operates in real time, in blockchain real time. If you consider the block interval like 13 seconds, for instance, on Ethereum, then 0.2 seconds on average are definitely real time. So this is the algorithm. So in green, you can see here these 3 lines of code. You could also write them in 1 line, but let's divide them here just for simplicity and clarity. So you have here a victim transaction, so where you replace the sender address of the victim with the adversarial transaction, which is yours, for instance. You specify the value of the transaction, right? So you just copy the value that you would like to assign to that transaction. And then the input of your new transaction, of your copycat transaction, will be the same input as the victim transaction, but you replace wherever you can find the victim sender, you replace it with your address. Right? So these are the three elements of an Ethereum transaction that you can set, for instance. I mean, there are some more, but these are the relevant ones. So the sender address, you want to adjust the value as well as the input data. And that's it, right? You literally, this is a string replacement algorithm. You replace the victim sender with your address. And that's it. This is the algorithm which we executed on these 32 months. And this is where we achieved a simulated profit. Unfortunately, we didn't make the profit ourselves, but we achieved a $35 million simulated profit here. I would like to draw your attention to this particular spike here in October 2020. And this spike was actually an attack. If I recall correctly, it was the Eminence hack, a hack that happened back then. And so it seems like that this very naive front-running algorithm, generalized front-running algorithm, could replay attacks. And that means that with the simple algorithm, you could prevent, or let's say white hat hack attacks, right? You can, this is in essence, this is an intrusion prevention system. So you could technically like once you see an attack on the network layer, you can attack an attacker, right? So you can front run the attack, and if you're being nice, then you can pay back the money that you captured through this generalized front running attack here. Okay, very good. Any questions so far on this end? All right. So maybe you will cover this, but I'm interested in the assessment of mitigations, fair ordering, consensus, MEV, and auctions. Yes, I will cover this. I think it should come in the next slide. So excellent transition. Thank you, Jeremy. So how can we mitigate MEV, right? What can we do? So there's a certain set of let's call them anti-BEV solutions. There's, for instance, the fair ordering on the blockchain layer. So Ari Jules, in particular, has developed the Equitas protocol family that may be a very promising direction. Another possibility is to design BEV mindful dApps. So, for instance, you could merge decentralized exchanges into one, such that users will automatically extract any potential arbitrage opportunities and not leave them on the table for others to take. So whenever you design a dApp, I would really recommend you to think about what are the market mechanisms that you are affecting, right? Are you creating any arbitrage opportunities for others to take and to compete on? And if you are, then can you somehow mitigate them, or can you transfer this wealth to the user of your dApp instead of leaving it to high frequency traders? So these mitigations might help on a single isolated blockchain, but it's unclear whether they will fix cross-chain blockchain extractable value, right? It's quite unclear how to fix that at all, because these different blockchains are not synchronized, and hence it's hard to do cross-blockchain executions. Although we've seen early signs of protocols proposing such schemes. So one particular application-specific MEV mitigation that we can discuss today is the idea of merging two automated market makers. So if you have here two markets for the assets X and Y, a trader might, as typically the case today, might swap X for Y on this market here, 1. And once this executed, then there is an army of bots that is backrunning you. So they will try to swap just right after you on these two markets in order to equilibrate the prices. So they might just do one transaction or two transactions, depends really on the situation. So this causes a plethora of issues, right? It causes backrunning, it causes potentially price gas auctions if there's a front-running attack. It causes network flooding. So we've seen bots creating hundreds of transactions from the same account with slightly different data, hence different transaction hashes, causing network congestion. And all this network congestion is decreasing the available bandwidth for blocks to propagate in the network. This is decreasing blockchain security, because the lower the bandwidth you have among miners, the higher the stale block rate becomes, which is negatively affecting the consensus security. So they're really like a plethora of negative implications. And this is all because the user forgoes an arbitrage opportunity, right? So the idea of merging these two markets is to create this aggregator that somehow performs optimal routing and arbitrage among at least these two markets, which may be the biggest on this particular chain, so that if the user trades the asset X for Y, this router, which is an on-chain contract, will then automatically and atomically swap among those two markets, so that the bots will be unhappy, but hopefully there's less blockchain extractable value. Well, the drawback of such a solution is still that this requires higher transaction fees for the user, right? So the execution of this transaction here, which entails these two swapped sub-transactions, this will necessarily require more gas or more execution costs on the client. We have done some preliminary study here, however, that with such a system and on Uniswap and SushiSwap in particular, we can cover over 90% of the transaction fees, which in return would technically be cheaper than doing a simple swap on only one DEX. However, our study, the scope of our study is a bit limited, because we can't test this in the real world, where we don't know what's going to be the reaction of other participants and how will this then evolve over time. So we don't know for sure how this will evolve. But still, I believe making dApps smarter in a sense and aggregating on-chain, not only for DEXs, decentralized exchange, but also maybe for lending or liquidation platforms may be an interesting avenue to explore. So as a summary, the blockchain extractable value. So we have three sources, right? So we have liquidations, arbitrage. So these are benign or considered benign sources. We have sandwich attacks, so where you wrap a victim within two adversarial transactions. And we have this fourth source, this transaction replay. That's a very application agnostic replay mechanism, where you don't know what you're replaying, you just try to replay, and it magically generates money. So these are the four kinds of BEV sources that we've seen. So thank you very much for your attention. I'm looking forward to any questions.
Thank you very much, Arthur, for a great talk, which is definitely outside what I know, but it's looks quite a big topic these days for what is happening in finance. Is there any questions? So Jeremy has already asked questions that you answered. Are there other questions?
Have you seen a rise of liquidations recently in DeFi? That's a really good question. So we have not looked at the empirical data yet for liquidations, but I'm pretty certain that the liquidations now, especially after the Terra event, increased significantly at that point in time, at least. I'm confident about this without looking at the data, which I shouldn't be confident about, but because I'm basing this on past experience, right? So here in March 2020, there was a significant drop in Ether. I think it was 30 or 40%. There we've seen quite a significant liquidation events. Same here for May 2021, right? This is where we have seen quite a number of liquidation events. What I might want to add here, we're actually not capturing MakerDAO, which is one of the major sources of liquidation events. MakerDAO operates a bit different from these four protocols. It has like an auction mechanism, but we can expect similar patterns for the events like a few weeks ago. Yeah.
One more question from Jeremy. For general arbitrage bots, how far along can one go, especially if users split functions across transactions, obfuscate actions with smart contracts, etc.
So how far can one go? So what specifically do you mean? Like here in this particular case, if the user splits transactions, so for this case, I believe it works best if there are two markets. If there are three markets, the execution costs will be significantly higher. So typically, so this wouldn't scale. I would think. We did measure the gas costs on 3 markets, and it was quite significant. So I don't think this can be scaled easily. Obfuscating actions within smart contracts, that's not really easy, right? So you can't really obfuscate much, as far as I'm aware. So Jeremy says, assuming you can't compute every ordering of transactions, okay? I mean, not specific to sandwich attacks, just generally maybe. Okay, if you can't compute, so okay, so the ordering, I mean, the ordering of transactions can be somewhat deterministic. For example, if you use front running as a service providers, such as flashbots. So miners nowadays are working with third-party intermediaries where you can send a so-called bundle. A bundle is a collection of transactions. So it can be an adversarial transaction, and then it can be a victim transaction. So you can bundle those two together and ask the miners to execute them at the very top of the next block. So at the high priority, right? And then you can always insist that this is going to be the order within at which transactions are being executed. So that's one way. And the other way is just to given a network state, you know that these X transactions are not yet executed, but you know how much fees they pay, so you can predict what will the order be, right? This is not a perfect solution, but it does work in expectation so far.
So there is one more question here with the flashbots and private replayers around. How is the future going to look in regards with arbitrage and front runnings?
Oh, thank you, Ali Reza. Very good question. So how's the future gonna be? It's a very tough one. I'm not an economist. As Ari said, I'm a technologist by nature. But I feel the flashbots is an intermediary, right? So they're slowing down the network layer for these blockchain extractable value extractors for these high frequency traders. So we've already seen signs, and that's not the future, that's present, of miners accepting so-called sandwich attacks, right? Or MEV in general. So we have seen miners that have an API where you can just say, I would like to execute this transaction, and I'm happy to pay you 50% of the profit or 90% of the profit. And it seems to me this is a more optimal mechanism, because the miners are receiving transactions and they can immediately mine them in their blocks, right? There's no intermediary that doesn't like any types of auction or anything. And the miner remains in control and has the lowest latency to the transaction issuer. So it's likely that this will happen, but we don't know. We don't know how miners will behave. They could do that. Miners could also fork the chain. So I haven't actually discussed any of the security implications of blockchain extractable value on the consensus layer, because they are the higher consequences. Because miners could deliberately fork the chain. We haven't seen much of that yet, but it would be the rational thing to do if you really just care about financial profit. Yeah, I hope that helps somehow. Jordan, ask a question. Yeah.
Yes, so it seems that many issues in DeFi are being answered with solutions requiring an aggregate. Are we just headed back towards a centralized system?
Yeah, that's an excellent question, Jordan. Thank you. So just to clarify here, this optimal routing and arbitrage aggregator, it's a smart contract. There's no server in between, right? So in that sense, it is decentralized because it's just a dApp, it's just a decentralized application running. In that sense, it may look centralized from a topology perspective, but it still remains non-custodial and decentralized application. But it's true that if we look on the network layer, it seems that these centralized intermediaries have gained a lot of traction and are capturing over 60% of the miner hash rate at the moment, which is alarming. Yeah, that's something we need to. I mean, if our goal is decentralization, then this is certainly something we should come up with better technology against that.
Okay, so one more question. So does the emergence of L2 blockchains with lower gas fees increase the risk of attacks across a wider surface?
Yeah, that's a tricky one. So lower gas fees decrease the risk for attackers, because if they fail, then they lose less, so they can attack more often, and in expectation gain more revenue. But typically these L2 blockchains also have a shorter block interval or a shorter commit interval. And the shorter this interval becomes, the harder it is for high frequency traders to front run, right? Because they need time to receive, to react, to compute and then to send out again. So it's unclear how these L2 blockchains will maybe even deteriorate attacks because they're just too fast. It's unclear. Yeah, a great point to study.
Yeah, I don't see any questions. So I may ask a question myself. So when you talked about your replay attacks, so these are, so in networking, replay attacks is replaying, but here it seemed that the part of the messages are changed and you're signing it. Is that a different type of replay attack? And how easy it is to do it, actually?
Absolutely. So the change that's happening is you take this input data, right? So there's a victim input data, and you replace just certain strings in there. And certain strings means you replace the address of the sender with the address of the adversary. Right? These are like 32 bytes of data, I believe. That's just a string replace algorithm, right? It's a simple grab and replace, literally.
But is it part of the signed data or not? It's not part. It's metadata that are not signed.
It is part of the signed data of the original transaction, but you can take that data, you can replace the address with yours and sign the entire blob again with your own key and send it out. Okay. So you do not require any other, you can just take your own key, whichever key you have access to or coins on to send out transactions. So it's definitely, it's absolutely feasible. We have seen instances of these being done in the wild.
Yeah, no, definitely. If you can sign it yourself, so it doesn't require that signature. So that's
exactly.
Yeah.
Yep.
Okay. Thank you.
Yeah, it's a. I mean, I find this quite puzzling because this algorithm works. If you call this revenue generation working proof. Despite the fact that you do not understand what the transaction is doing, right? You have no knowledge about the application layer, what's happening. There's nothing required of you to understand, which is quite puzzling.
Okay, so it's a kind of random attack. So what do you need to know to do this attack? What is the goal of the attacker?
I mean, the goal of the attack is just to make money. And at times you catch, you might replay an arbitrage transaction, right? You might replay a liquidation transaction if you're lucky, but you also might replay just an attack, like a DeFi attack, as we've seen here in October 2020, right? This 10 million revenue transaction here, this was an attack that the attacker was able to replay. So it's like, it's a very generic method that can replay any type of transaction without understanding what the victim transaction is doing. Yeah, and that's
kind of random attack in this sense.
It's completely random because it has no understanding of what it attacks, but it can attack. Yeah.
Interesting. Yeah, very interesting. Any other questions? If not, I think, thank you very much, Arthur. It was a great talk and very eye-opening for all of us. And yeah, so.
Yeah, thank you so much.
And thanks for answering all the questions so nicely and convincingly. Thank you.
Thank you, Ray. Okay. Thank you very much.
Thanks.